People look forward to doing their taxes about as much as they look forward to a dental procedure or jury duty. But you know what they look forward to even less? Finding out they got nailed by a tax they've never even heard of because they had one good year, or maybe a couple. But if you can relate to this, then stick around, because by the end of this video, you should have a better understanding of what net investment income tax is and how it can mess with your tax efficiency. We'll also cover a few strategies that may help you avoid or reduce it in future years. Hey everybody, I'm Curtis Crossland of Suttle Crossland Wealth Advisors, and I help people build more tax efficient retirements. So let's figure this thing out. Now, for a lot of individuals, their first experience with net investment income tax is gonna feel like it came out of nowhere. This is because of the nature of this specific tax and what triggers it. And this is also where a cavalier attitude of let me just get my taxes over with can come back to haunt you. We'll talk more about that, but first an explanation, and I hope you're sitting down. The NIIT is imposed by the Internal Revenue Code as an additional tax at a rate of 3.8% on certain net investment incomes for individuals, estates, and trusts that have high income above statutory threshold amounts. So what is this in plain English? Well, it's a surtax if you have certain types of investment income above certain thresholds. The problem in understanding net investment income tax is that while the application of it is very formulaic in that you are subject to it or you're not, it can feel like the IRS is only sticking it to people if it's a full moon on a Tuesday. And NIIT tax can hurt, especially if it's piled up on top of an already high income tax situation. And while you may feel like it's too hard to keep track of, the key is to not let any confusion on this get you lazy in your thinking about your financial decision making as the year progresses. And while this message is especially for retirees and high earners that may have multiple income sources, this can also affect the average Joe and Jane that may have one or two above average years of success. Thinking of this as a double trigger, high investment income coupled with high modified adjusted gross income is a recipe for Uncle Sam to get this surtax from you. So if you're not careful, you could end up needlessly subjecting yourself to this, and maybe for more years than you'd like. The reality is you gotta pay attention, folks. Sorry. Now we need to define a few things, and then we can look at an example of how this can affect you. When it comes to individuals, that 3.8% surtax is on the lesser of net investment income or excess of modified adjusted gross income over the following thresholds. $250,000 for married filing jointly or qualifying surviving spouse, $125,000 for married filing separately, or $200,000 for single or head of household. Now, I already know what you're thinking. Hey, this is hurting my brain, but hang in there. And let's take a look at the definition of net investment income according to the IRS. As we read through this list of what's included, the common theme you're hopefully picking up on is passive activity. This line in particular, the net investment income tax, or NIIT, applies to income from a trade or business that is 1, a passive activity as determined under Section 469 of the taxpayer, or 2, trading in financial instruments or commodities as determined under Section 475(e)(2). So again, the idea behind this surtax is to use passive investment income to help pay for healthcare reform, but uses modified adjusted gross income as part of the test to make sure that the taxes collected from this particular surtax do not needlessly punish those with lower income. Let's take a look at a simple example of how net investment income tax can be applied. For our example, we're going to use Joe and Jane, a married couple that uses married filing jointly as their tax filing status. We'll say that their total modified adjusted gross income is going to amount to $400,000 for the year. Now, part of that modified adjusted gross income is going to consist of $25,000 in stock dividends, and $50,000 is going to come from gains from the sale of stock throughout the year. We're also going to say that they have no other sources of net investment income. Since their threshold for married filing jointly is $250,000, their excess modified adjusted gross income is going to amount to $150,000, and their net investment income is going to amount to $75,000. The 3.8% NIIT surtax is going to apply on the lesser amount. Since $75,000 is less than $150,000 in this example, this means that their particular NIIT calculation in this example comes to $2,850. Everyone's situation is going to vary, but you can see how easy it can be to get confused by this or misunderstand its impact. Paying attention to this detail can sometimes make the difference in your financial decision making and whether you can avoid any NIIT or whether you're going to get nailed by a little or a lot. So what are some strategies that can help us deal with NIIT? Well, for starters, having a tax-efficient investment strategy. This can mean leaning on an indexed or passive strategy at the very least for your taxable accounts. If the goal is to reduce passive investment income, we may not necessarily want to force high dividends or capital gains on ourselves. Tax-efficient strategies also seek to utilize asset location principles. The goal of this strategy is to allocate your stocks and bonds across taxable and deferred accounts in a way to help lower your tax drag. Another strategy is to consider specific lot identification when there's a need to reallocate, rebalance, or harvest gains and loss. Targeting specific lots may provide an opportunity to reduce net investment income in current periods. And targeting specific lots for the sake of loss harvesting can create tax assets for future use. Imagine being able to reduce a bit of current income or help reduce other gain because you strategically harvested those losses in prior years. One last strategy to mention, much like the last one, considers what you can do in opportune years to get ahead of potential future NIIT assessment. If you project to have high income in future years because of things like Social Security, pensions, required minimum distributions, or other income sources, looking to see if Roth conversion strategies or strategic use of pre-tax assets in earlier opportune income years has the potential to affect future modified adjusted gross income. Now, it should be noted that there are going to be plenty of scenarios and situations where net investment income tax is just unavoidable. But understanding where you stand and what those net investment income tax triggers are can help you in situations where that net investment income tax may be avoidable. Every year may require its own intervention, so stay diligent. If you don't prepare your own taxes, or if your eyes glaze over when your preparer is explaining your situation to you, you may miss the assessment of net investment income tax altogether. And at other times, you may be made painfully aware of it and wonder why the universe has it out for you. In any event, there are times where net investment income tax can be reduced or potentially avoided, depending on the situation. And the bottom line is this can get complicated and is most certainly situationally dependent. My hope is that topics like this get you curious about your own situation so you can build a more tax-efficient future and retirement. And please note that tax laws can change. You should always look to work with or consult with a qualified and licensed professional before you act on anything, especially things you see on the internet. Do your homework, folks. Once more, I'm Curtis Crossland, and if you want to see how we help folks build more tax-focused and efficient retirements, check us out at SuttleCrossland.com and subscribe for more educational videos.